Hello everyone, and welcome to my channel. In this video, we're going to talk about investing in single stocks. Single stocks are shares of ownership in individual companies that are traded on the stock market. They are different from other types of investments, such as mutual funds, exchange-traded funds, or index funds, which are collections of stocks or other assets that are managed by a fund manager or follow a specific benchmark. Investing in single stocks can be very rewarding, but also very risky. So in this video, I'm going to help you decide whether investing in single stocks is a smart investment or a risky gamble. Let's start with the advantages of investing in single stocks. Here are some benefits of investing in single stocks. You can earn high returns from capital appreciation and dividends. Capital appreciation is when the price of a stock increases over time, and dividends are payments that some companies make to their shareholders from their profits. If you invest in a stock that performs well and pays dividends, you can make a lot of money from your investment. You can choose specific companies, sectors, or industries that match your interests, values, or goals. You can invest in companies that you like, admire, or believe in, and support their vision, mission, or products. You can also invest in sectors or industries that you think have high growth potential, such as technology, healthcare, or renewable energy. You can benefit from market inefficiencies, insider information, or special situations. Market inefficiencies are when the price of a stock does not reflect its true value, due to factors such as lack of information, irrational behavior, or manipulation. Insider information is when you have access to privileged information that is not available to the public, such as earnings reports, mergers and acquisitions, or product launches. Special situations are when you have an opportunity to profit from an event that affects the value of a stock, such as a spin-off, a buyout, or a bankruptcy. If you can spot these opportunities and act on them before others do, you can gain an edge over the market and earn higher returns. You have flexibility to buy and sell stocks at any time, without paying fees or commissions to fund managers or brokers. You can buy and sell stocks whenever you want during trading hours, without having to wait for approval or confirmation from anyone else. You also don't have to pay any fees or commissions to fund managers or brokers who manage your investments for you. You only have to pay a small transaction fee to the platform or service that you use to trade stocks. You have control over your portfolio allocation, risk level, and tax strategy. You can decide how much of your portfolio you want to allocate to different stocks, based on your own research, analysis, and preferences. You can also decide how much risk you are willing to take by choosing stocks that have different levels of volatility, liquidity, and leverage. You can also decide how to optimize your tax strategy by choosing stocks that have different tax implications, such as capital gains tax, dividend tax, or foreign tax. These are some advantages of investing in single stocks. However, investing in single stocks also has some disadvantages. Here are some drawbacks of investing in single stocks. You have a high risk of losing money from market volatility, company failure, fraud, or bankruptcy. Market volatility is when the price of a stock fluctuates rapidly and unpredictably, due to factors such as supply and demand, news and events, or emotions and sentiments. Company failure is when a company performs poorly or goes out of business, due to factors such as competition, innovation, or regulation. Fraud is when a company deceives its investors or the public by falsifying its financial statements, hiding its liabilities, or inflating its revenues. Bankruptcy is when a company cannot pay its debts and has to liquidate its assets or restructure its operations. If you invest in a stock that suffers from any of these scenarios, you can lose part or all of your investment. You need extensive research, analysis, and monitoring of individual stocks and their performance. Investing in single stocks requires a lot of time, effort, and knowledge. You need to research each stock that you want to invest in and evaluate its fundamentals, such as earnings, revenue, growth, profitability, and valuation. You also need to analyze its technical indicators, such as price trends, volume patterns. and momentum signals. You also need to monitor its performance regularly and compare it with your expectations and goals. You also need to keep up with the news and events that affect the stock market and the industry that the stock belongs to. You have difficulty in diversifying across different types of assets, sectors, or regions, which can increase your exposure to specific risks. Diversification is when you spread your investment across different types of assets, sectors, or regions that have different characteristics and performance. Diversification can reduce your risk by lowering the impact of any single asset, sector, or region on your portfolio. However, investing in single stocks can make it hard to diversify your portfolio, because you need a large amount of money to buy enough stocks to achieve diversification. You also need to research and analyze each stock that you want to add to your portfolio, which can be time-consuming and costly. You have a challenge in beating the market average or benchmark, which can require superior skills, knowledge, or luck. The market average or benchmark is the standard that you use to measure your portfolio performance, such as the S&P 500 index or the Dow Jones Industrial Average. Beating the market average or benchmark means that you earn higher returns than the market average or benchmark. However, beating the market average or benchmark can be very difficult, because the market average or benchmark reflects the collective wisdom and actions of millions of investors who are constantly buying and selling stocks. To beat the market average or benchmark, you need to have superior skills, knowledge, or luck that allow you to identify and exploit market opportunities and trends before others do. You have responsibility for managing your own portfolio, which can be time-consuming, stressful, and costly. Managing your own portfolio means that you have to make all the decisions and actions related to your investments, such as choosing stocks, executing trades, monitoring performance, and adjusting allocation. Managing your own portfolio can be time-consuming, because you have to spend a lot of time researching, analyzing, and monitoring your stocks in the market. Managing your own portfolio can be stressful, because you have to deal with uncertainty, volatility, and emotions that can affect your judgment and performance. Managing your own portfolio can be costly, because you have to pay for various expenses related to your investments, such as transaction fees, taxes, and software. These are some disadvantages of investing in single stocks. So how can you invest in single stocks wisely? Here are some tips and best practices for investing in single stocks wisely. Define your investment objectives, risk tolerance, time horizon, and budget before buying any stocks. You need to know why you are investing, how much risk you are willing to take, how long you plan to hold your investment, and how much money you have to invest. These factors will help you choose the right stocks for your portfolio. Do your due diligence on each stock that you want to invest in and evaluate its fundamentals, technical indicators, and market sentiment. You need to research each stock thoroughly and objectively, and assess its strengths, weaknesses, opportunities, and threats. You also need to analyze its price movements and patterns, and look for signals that indicate its direction and momentum. You also need to monitor its popularity and reputation among investors and the public, and look for clues that indicate its demand and supply. Diversify your portfolio by investing in at least 15 to 20 different stocks across different sectors and regions. You need to spread your investment across different stocks that have different characteristics and performance, so that you can reduce your exposure to specific risks. You also need to balance your portfolio between growth stocks and value stocks, between large cap stocks and small cap stocks, and between domestic stocks and international stocks. Use a buy and hold strategy rather than a buy and sell strategy, and avoid chasing short-term trends or fads. You need to invest in stocks for the long term, rather than trading them frequently for quick profits. You also need to avoid following the crowd or the hype, and stick to your own research, analysis, and judgment. You also need to be patient and disciplined, and resist the temptation to sell your stocks when they go down or buy more when they go up. Rebalance your portfolio periodically to maintain your desired allocation and risk level. You need to review your portfolio regularly and compare it with your investment objectives, risk tolerance, time horizon, and budget. You also need to adjust your portfolio allocation if necessary, by selling some of the stocks that have increased in value or buying some of the stocks that have decreased in value. You also need to consider adding new stocks or removing old ones from your portfolio, based on their performance and potential. Keep track of your portfolio performance and adjust accordingly based on market conditions and your goals. You need to measure your portfolio performance using metrics such as return, risk, Sharpe ratio, and drawdown. You also need to compare your portfolio performance with the market average or benchmark, and with your expectations and goals. You also need to adjust your portfolio accordingly based on market conditions such as trend cycles or events and based on your goals such as income growth or preservation. These are some tips and best practices for investing in single stocks wisely. Investing in single stocks can be a smart investment or a risky gamble depending on how you do it. If you do it wisely, you can enjoy high returns, personal satisfaction, and financial freedom. If you do it poorly, you can suffer huge losses, emotional stress, and financial ruin. So how can you learn more about investing in single stocks? Here are some resources that can help you. Books. There are many books that can teach you the basics and the advanced techniques of investing in single stocks. Some of the most popular and recommended books are The Intelligent Investor by Benjamin Graham, One Up on Wall Street by Peter Lynch, and The Little Book of Common Sense Investing by John C. Bogle. Blogs. There are many blogs that can provide you with the latest news, insights, and tips on investing in single stocks. Some of the most popular and reputable blogs are The Motley Fool, Seeking Alpha, and Investopedia. Podcasts. There are many podcasts that can offer you the best advice, interviews, and stories on investing in single stocks. Some of the most popular and informative podcasts are the Stock Podcast, the Investing for Beginners Podcast, and the Money Tree Investing Podcast. Websites. There are many websites that can help you with research, analysis, and trading of single stocks. Some of the most popular and useful websites are Yahoo Finance, Morningstar, and E-Trade. These are some resources that can help you with investing in single stocks. I hope you found this video helpful and informative. If you did, please give it a thumbs up and subscribe to my channel for more videos on investing in single stocks. Also, please leave a comment below and share your feedback or questions on investing in single stocks. What are your favorite stocks to invest in? What are your investment objectives, risk tolerance, time horizon, and budget? How do you research, analyze, and monitor your stocks? How do you diversify your portfolio? How do you measure your portfolio performance? Please, make sure you hit the subscribe button and the bell icon so you don't miss any of my future videos. And if you find this video helpful, please give it a thumbs up and leave a comment below. I would love to hear from you. Thank you for watching, and I'll see you in the next video.